Gulf tanker attack. Iran just struck a U.S. oil tanker right in the middle of the world's most dangerous waters, and the entire global economy is holding its breath, thick black smoke rising miles into the sky, emergency vessels rushing in. But here's what nobody is telling you. This wasn't just an attack on a ship. This was an attack on your fuel prices, your food supply, your economy. And the world has never been closer to something far worse than just a burning tanker. Welcome to Currency Archives, the channel where we decode what the world's most powerful people don't want you to understand. Now listen, if you're above 50 years of age, you've seen wars, you've seen oil shocks, you've seen empires rise and fall, but what's happening in that Gulf right now, you've never seen anything like this before. Hit that subscribe button, because this story is only just beginning. And where in the world are you watching this from? Drop your country in the comments below. On a quiet morning in the Gulf, the water was calm. The tankers were moving slowly, as they always do, carrying millions of barrels of oil through one of the most watched stretches of water on the planet. And then, everything changed. According to Iranian state television, Iranian forces struck a U.S. oil tanker moving through Gulf waters. The images that followed were unlike anything seen in recent memory. A massive vessel, built to survive the harshest conditions at sea, was engulfed in flames. Thick black smoke rose high into the sky, visible for miles in every direction. Emergency response vessels rushed toward the burning ship. Crew members scrambled for safety, and the world watched in silence, trying to understand what had just happened. But here's the critical question that nobody in the mainstream media is asking clearly enough. How did it come to this? To understand the answer, one must go back. Not days, not weeks, but decades. The Gulf has never been a peaceful body of water. It sits at the center of the world's most volatile region, surrounded by nations with competing interests, ancient rivalries, and enormous oil wealth. For generations, whoever controlled the Gulf controlled the energy supply of the entire planet. And that power, that extraordinary economic leverage, has always made the Gulf a target. In the 1980s, during the Iran-Iraq War, the world witnessed what became known as the tanker wars. Iranian and Iraqi forces attacked oil tankers repeatedly, disrupting global supply chains and sending oil prices into chaos. The United States eventually intervened, escorting Kuwaiti tankers under American flags to protect them from attack. The message from Washington was clear. The Gulf shipping lanes belong to no single nation. They belong to the global economy. That message was delivered 4 decades ago. Today, it appears Tehran has chosen to challenge it again. The geography of this attack matters enormously, and very few people are talking about it with the seriousness it deserves. The Gulf is not simply a body of water. It is the economic lifeline of the modern world. Every single day, approximately 17 to 21 million barrels of oil pass through the Strait of Hormuz, the narrow passage connecting the Gulf to the wider ocean. That number represents nearly 20% of the world's total oil supply moving through a corridor that, at its narrowest point, is only 21 miles wide. 21 miles. That is the margin between global energy stability and global energy crisis. When a tanker burns in those waters, it is not simply a maritime incident, it is a signal, sent deliberately, carefully, and with full knowledge of what it means to every oil market, every shipping company, every government, and every economy on Earth. Now, here's where the story becomes deeply important for anyone in the business community. Iranian state television was quick to claim responsibility, but the United States government, at the time of initial reports, remained largely silent. No immediate confirmation, no immediate denial, just silence. And that silence is significant. In geopolitical conflicts of this nature, silence from a major power does not mean confusion. It means calculation. Washington was watching, assessing, deciding how to respond in a way that neither escalates the situation uncontrollably nor signals weakness to Tehran. Because here is the reality that serious analysts understand clearly. Every response has a cost. A military response risks a wider war in the Gulf, which would immediately close shipping lanes and send oil prices to levels not seen in modern history. A diplomatic response risks appearing weak, which historically invites further aggression. And no response at all risks something far more dangerous, the normalization of attacking American assets in international waters. There is no easy path forward. What happened in the Gulf that morning was not simply an attack on a tanker. It was a calculated move, designed to test limits, apply pressure, and send a message to Washington, to global markets, and to every nation that depends on Gulf oil to keep its economy running. The tanker is burning. But the real question, the question that will define the next chapter of this crisis, is not what Iran did. It is what happens next. There's a number that every serious economist knows by heart, 20%. That is the share of the world's entire oil supply that moves through a single stretch of water every single day. Not through a pipeline, not through a railway, through open water, exposed water, water that, as the world just witnessed, can be targeted, disrupted, and set on fire. And today, that number is no longer just a statistic, it is a warning. Within hours of the tanker attack, the reaction in global energy markets was immediate and brutal. Crude oil prices surged. Traders who had been watching the Gulf situation with cautious concern suddenly shifted into panic mode. Brent crude, the global benchmark for oil pricing, began climbing at a rate that analysts had not seen since the early days of the Russia-Ukraine conflict. Every percentage point of that climb carries an enormous real-world consequence for fuel prices, for transportation costs, for the price of every single product that moves by ship, truck, or plane anywhere on Earth. But here is what most people watching the news do not understand. The price of oil is not just the price of gasoline at the pump, it is the price of everything. Consider the supply chain that sustains modern civilization. When oil prices rise sharply, the first casualties are always the most visible ones. Airlines, shipping companies, logistics firms. Their operating costs surge overnight. Ticket prices rise. Freight costs climb. The goods that were already on their way to store shelves suddenly cost more to deliver. And those costs do not disappear. They are passed directly to the consumer, to the businessman restocking his inventory, to the entrepreneur managing his supply chain, to the ordinary family filling their refrigerator. This is the mechanism that most financial commentators fail to explain clearly enough. An oil shock does not stay in the energy sector. It spreads quietly, systematically, and with devastating efficiency through every sector of the global economy simultaneously. Now focus on the Strait of Hormuz, because this is where the real danger lives. The strait is the single most important maritime choke point on Earth. Every major oil-producing nation in the Gulf region, Saudi Arabia, Kuwait, the UAE, Qatar, Iraq, depends on this narrow passage to export its energy to the world. There is no alternative route that can handle the volume. There is no pipeline network large enough to compensate. If the Strait of Hormuz is disrupted, even partially, even temporarily, the consequences for global energy supply are immediate and catastrophic. And Iran knows this better than anyone. Tehran sits directly on the northern shore of the strait. Iranian military assets, missiles, drones, naval forces, are positioned within striking distance of every tanker that passes through. This is not an accident of geography. It is a strategic asset that Iran has spent decades developing and defending. The ability to threaten the strait is Iran's most powerful economic weapon. And today, the world received a very clear demonstration of Tehran's willingness to use it. There is another dimension to this crisis that the business community must understand immediately: shipping insurance. When conflict erupts in a major maritime zone, insurance companies do not wait for official government declarations. They act immediately, and their actions have enormous consequences. War risk premiums for vessels transiting the Gulf have already begun climbing sharply. Lloyd's of London and other major marine insurers are reassessing their exposure in real time. When insurance costs surge, shipping companies face an immediate choice: absorb the losses, pass the costs to customers, or avoid the route entirely. Many will choose to avoid the route. And when ships stop moving through the Gulf, the oil stops flowing. Here is the brutal economic reality that no government wants to say out loud. The global economy was already fragile before this attack. Inflation had not fully retreated. Interest rates remained elevated across major economies. Supply chains were still recovering from years of disruption. And now, at precisely the wrong moment, the world's most critical energy corridor has been turned into an active conflict zone. The tanker that burned in the Gulf was carrying oil, but what is burning now is far more valuable than oil. It is confidence. The confidence of markets, the confidence of investors, the confidence of every business leader trying to plan for a future that just became dramatically more uncertain. And once that confidence is gone, it is far harder to recover than any tanker ever could be. There is a concept in economics that most people learn about in textbooks, but never truly understand until they live through it. It is called the domino effect. And right now, the first domino has already fallen. Most people watching the burning tanker footage on their screens made the same assumption. They assumed this was an energy story, a Middle East story, a story about oil prices and military tensions that would eventually stabilize, as these situations always seem to, eventually. They are wrong. What is unfolding in the Gulf right now is not an energy story. It is a supply chain story. And supply chain stories do not stay in one place. They travel, silently, invisibly, and with a speed that governments and corporations consistently underestimate until the damage is already done. Begin with the most immediate connection that nobody in mainstream financial media is discussing seriously enough: food. The relationship between oil prices and food prices is one of the most well-documented and consistently underreported dynamics in global economics. Every stage of modern food production depends on energy. Fertilizers are manufactured using natural gas. Farming equipment runs on diesel. Food processing facilities consume enormous quantities of electricity. Refrigerated trucks, cargo ships, and distribution networks, all of it powered by the same energy supply that just became dramatically more expensive and uncertain overnight. When oil prices surge by 20, 30, or 40%, as analysts are now beginning to project if Gulf tensions escalate further, food prices do not simply rise modestly, they spike, and they spike hardest in the places least equipped to absorb the shock. Emerging markets, developing economies, and the middle-class households in developed nations that are already stretched thin after years of inflation. This is the human cost of a tanker attack that nobody puts on the front page. Now move to the financial markets, because what is happening there tells a story that every entrepreneur and business professional must understand with absolute clarity. Asian markets were the first to react. The Nikkei in Japan dropped sharply. The Kospi in South Korea followed. Samsung, one of the most globally exposed technology companies on Earth, saw its stock price fall in a single session by a margin that erased billions in market value. These are not small, isolated movements. These are early warning signals from the most economically sensitive markets in the world. Markets that depend almost entirely on imported energy to power their manufacturing sectors. When Asian markets move this way, European markets follow. And when European markets follow, Wall Street begins to price in the fear. And when Wall Street prices in fear at the scale the situation demands, the correction that follows is not measured in percentages. It is measured in trillions. Consider now the position of the global shipping industry, an industry that most entrepreneurs and business leaders take entirely for granted until the moment it stops functioning. The world's major shipping companies are already making contingency calculations. Rerouting vessels away from the Gulf adds thousands of miles to every journey, miles that translate directly into days of additional transit time and hundreds of thousands of dollars in additional operating costs per vessel. For businesses that depend on just-in-time inventory management, a system built on the assumption that supply chains will function with near-perfect reliability, even a 2-week disruption in Gulf shipping creates cascading shortages that take months to resolve. The electronics industry is exposed, the automotive industry is exposed, the pharmaceutical supply chain, which depends on chemical precursors manufactured in Gulf-adjacent regions, is exposed in ways that most consumers will not understand until medications begin disappearing from pharmacy shelves. This is not speculation. This is the documented pattern of every major Gulf disruption in modern history. Now examine the United States Strategic Petroleum Reserve, the buffer that Washington has always positioned as its primary defense against exactly this kind of energy shock. The reserve exists, but it is not unlimited. And it has already been drawn down significantly in recent years during previous energy crises. The cushion that once gave American policymakers months of breathing room in a Gulf disruption now provides a far narrower window of response. Meanwhile, China and India, the two largest importers of Gulf oil after the United States, are making their own calculations quietly and without any particular concern for Western preferences. Both nations have maintained energy relationships with Iran that circumvent Western sanctions. Both nations will continue purchasing oil regardless of what Washington demands. And both nations understand clearly that a prolonged Gulf disruption weakens the Western economies far more than it weakens their own. That asymmetry is not accidental. It is strategic. Here is what every serious business professional must understand about this moment. Supply chains are not resilient by nature. They are resilient by design, and only when the conditions that designers assumed would hold actually hold. The moment a critical assumption breaks, and a burning tanker in the Gulf's most sensitive corridor is precisely that kind of assumption-breaking event. The entire architecture of global trade becomes fragile in ways that no single government, no single corporation, and no single contingency plan can fully address. The dominoes are not falling slowly, they are falling fast. And the question that every business leader, every investor, and every entrepreneur must now ask themselves is not whether this disruption will affect them. It is how quickly they can position themselves before the next domino falls. Every move in geopolitics has a reason behind it. Every strike, every provocation, every carefully timed act of aggression is never truly about what it appears to be on the surface, and what Iran just did in the Gulf is no exception. To understand Iran's real strategic calculation, one must step back from the burning tanker, step back from the surging oil prices, step back from the chaos of market reactions, and ask a single fundamental question that cuts through all of it. Why now? Because timing in geopolitics is never accidental. Nations do not strike American assets in international waters on a random Tuesday morning without a precise calculation behind that decision. Every variable, the political climate in Washington, the state of global oil markets, the position of allied and adversarial powers, the internal pressures within Tehran itself, every single variable was weighed before that order was given. And when those variables are examined carefully, the answer becomes deeply uncomfortable. Iran has been living under one of the most severe economic sanction regimes in modern history for decades. Its currency has collapsed. Its middle class has been hollowed out. Its access to international banking, to foreign investment, and to the global financial system has been systematically severed by Washington and its allies. By conventional economic logic, Iran should be weakened, desperate, isolated, and without meaningful leverage on the global stage. But here is what the architects of that sanctions regime consistently underestimated. Desperation does not always produce submission. Sometimes it produces strategy. Iran's leadership, whatever one thinks of its political character, has spent years developing an economic warfare doctrine that does not require military superiority over the United States. It does not require a blue water navy. It does not require aircraft carriers or fifth-generation fighter jets. It requires only one thing: the ability to make the cost of confrontation unbearable for everyone else. That doctrine has a precise name in strategic circles. It is called asymmetric economic warfare, and the burning tanker in the Gulf is its clearest expression yet. Here is how the calculation works in practice. Iran cannot defeat the United States in a conventional military engagement. No serious analyst in Tehran believes otherwise, but Iran does not need to defeat America militarily to achieve its strategic objectives. It needs only to raise the economic cost of American pressure to a level that makes continued confrontation politically unsustainable in Washington. Every percentage point that oil prices climb, every $1 billion wiped from global stock markets, every shipping company that reroutes away from the Gulf, every government in Europe and Asia that calls Washington and says, quietly, privately, urgently, that their economies cannot absorb another shock of this magnitude, is a point scored for Tehran, not on a battlefield, in a boardroom. Now examine the position of the United States with the same analytical clarity. Washington faces a set of options that are each deeply problematic in their own way. A direct military strike against Iranian assets risks triggering a full-scale Gulf conflict, the consequences of which would include an immediate closure of the Strait of Hormuz, an oil price spike that would dwarf anything seen in modern history, and a global recession that would make the 2008 financial crisis appear manageable by comparison. Diplomatic pressure, sanctions, international condemnation, coalition building has already been applied at maximum intensity for years. Iran has demonstrated repeatedly and unambiguously that it can absorb that pressure without fundamentally changing its behavior. And withdrawal, any signal that Washington is stepping back from its commitments in the Gulf, would be read by every adversarial power on earth as an open invitation. Russia would notice. China would notice. And every smaller nation currently calculating whether American security guarantees are worth depending upon would quietly begin making alternative arrangements. There's a 72-hour window that strategic analysts are watching with extraordinary attention right now. In the immediate aftermath of a provocation of this magnitude, the responses that emerge, or fail to emerge, from Washington, from Tehran, from Riyadh, from Beijing, will set the trajectory of this crisis for months, possibly years, to come. If Washington responds with overwhelming force, the Gulf goes dark. If Washington responds with restraint, Iran's calculus is validated, and the next strike becomes more likely, not less. If no coherent response emerges at all, the vacuum will be filled, as vacuums in geopolitics always are, by the most aggressive actor in the room. And in the Gulf right now, that actor has already shown the world exactly what it is willing to do. Here's the final truth that every business professional, every investor, and every entrepreneur watching this situation must internalize before the next market session opens. This is not a regional conflict. It never was. It is a global economic confrontation being fought, deliberately, strategically, and with precise calculation, through the language of energy markets, shipping lanes, and supply chain disruption. The weapons are not only missiles and drones, they are oil prices, they are insurance premiums, they are the quiet decisions made in corporate boardrooms to delay investments, reduce exposure, and hold cash rather than deploy capital into an uncertain world. Iran understands this language fluently, and it is speaking it now, louder than ever before. The tanker is burning in the Gulf, the markets are burning across the world, and the question that history will eventually answer is whether the world's most powerful nations were truly prepared for a war that was never meant to be fought with guns.